What if you could set up a trading system that handles everything, entries, exits, risk, while you focus on living your life? So in this video, I'm going to take you inside the tools and rules that make automation possible and reveal how you can build a self-running system that actually works in the real world. So most people think automation means completely hands off. But real automation, it's not like putting your car in cruise control and simply kicking back. It's much more like an aircraft on autopilot. Cruise control, it assumes a flat and empty highway. Autopilot, it expects turbulence and it's actually built to handle it. You see, before takeoff, the system is designed so that when the weather shifts, the plane already knows how to react. That's what a real self-running trading system is. A framework where the rules, the risk, and the execution are engineered up front. So you're not making big decisions while the market's throwing curveballs. Unlike cruise control, where if someone cuts out in front of you, you're forced to grab the wheel and save yourself. And proper systems, though once built, they just fly the route it was designed to fly no matter what the weather looks like. And that's the difference between automation and systems that survive real markets and internet bots that look great right up until the first real storm hits. So if you want a system that truly runs itself, not one that needs constant babysitting, you have to build it in the right order, because automation isn't the starting point, it's actually the final layer. So before you place a single trade or write a single line of code, you need a solid foundation. And that's what determines whether your system is going to quietly compound in the background or quietly collapse the moment conditions change. Now, I've personally worked with over 300 clients in the last few years to build automated trading systems that follow these exact principles. So for the rest of this video, let's dive into the 5 core steps that we use to engineer self-running systems designed for real capital and real volatility. So let's look at the 5 core steps to a self-running trading system. Step 1 is define the strategy before you automate everything. Now, the number one mistake people make with automation, they think it'll fix a bad strategy, but it doesn't. Automation doesn't correct weakness, it actually amplifies it. So if your logic is flawed, automation just lets that flaw run wild, faster, more often, and even on a bigger scale. And that's why before you touch a single line of code, a bot, or API, you need a strategy that's absolutely crystal clear. Not sort of clear, not I'll know it when I see it. It needs to be so precise it can run without you. And you need to understand it philosophically, strategically, psychologically. It's just so important. And this stage, the real work isn't technical. It's what I'm talking about. It's that conceptual. You need to know exactly what triggers that entry. Not because you feel good about the market, but because a specific set of conditions creates a positive expected value. And just as important, you got to know what cancels that entry. A real strategy isn't defined by when it gets in, it's defined by how it handles things when the market doesn't play along. If price moves against you, the system shouldn't panic, hesitate, or improvise. It should already know what to do. That means you design capital behavior up front. How much are you risking per trade? How does your size change as price moves? When does the system defend and when does it wait? When these answers are baked in before automation, your system doesn't need to predict the future. It doesn't need to be right. It just needs to be consistent, and that's key. A self-running system is built on rules and not gut feelings. So if a human still needs to decide if a signal looks good, your system can't run itself. And if your entries depend on intuition, news, or confidence, you're always going to be babysitting. So true automation only works when your strategy is so well defined that execution becomes mechanical. And once you have that foundation, everything else, algorithms, automation, scaling, become absolutely possible. But without it, automation is just speed without direction. So step 2 is use an algorithm to enforce the rules. This is the moment where consistency is actually born. Up until now, maybe you've had your rules scribbled on a notepad or a strategy kind of floating around in your head. Maybe you even try to follow a checklist, but as long as you're the one pushing the buttons, your system is going to be vulnerable to hesitation, to second guessing, and good old-fashioned fatigue. An algorithm changes that instantly. Once your rules are crystal clear, the algorithm's job isn't to be clever or creative. Its job is simple and incredibly powerful. It executes the plan exactly as designed. It doesn't pause when price moves fast. It doesn't hesitate because the last trade stung. It doesn't override itself because a chart looks weird this time. And it never reacts emotionally to noise. That mechanical enforcement is what turns a strategy into a true system. And here's the key shift. You are no longer the execution layer. The system is. This separation is critical because most trading damage doesn't come from bad ideas. It comes from good ideas applied inconsistently. Humans don't fail because they don't know the rules. They fail because they bend them, especially under stress. And an algorithm, it just doesn't do that. It doesn't feel relief after a win or desperation after a loss. It doesn't get bored or antsy. It just follows instructions. It just follows rules. Over time, this wipes out decision fatigue. No more micro decisions draining your attention. No more internal debates about whether this time is different. Behavioral errors, the kind that quietly bleed accounts dry, aren't fixed by discipline. They're eliminated by design. And that's the real breakthrough. You stop trying to be a perfect trader and instead you build a system that doesn't require you to be perfect at all. Once execution is fully handed off to the algorithm, your job completely changes. You're not reacting to the market anymore. You're overseeing a machine that was built already to handle it. And that's what makes everything else possible, the algorithm. Now, let's go to step 3. You need to engineer risk around the portfolio and not the trade. And this is where most systems quietly break, and not because the strategy is bad or the entries are wrong, but because the risk was never engineered at the level that actually matters. You see, risk isn't managed trade by trade. It's managed at the portfolio level. A single trade almost never destroys the system. What destroys a system is accumulated exposure, the way multiple positions stack up with volatility, with time, and capital during rough conditions. That's why before your system ever goes live, position sizing, safety orders, and exposure limits, they must be engineered up front, not guessed in the moment, not adjusted on a whim, designed. Account size matters, volatility matters, worst case scenarios, they matter too. The system must be built with the assumption that things won't go perfectly because they never actually do. And above all, it has to be built for survival, not just optimization. Optimization looks great in backtests. Survival is what keeps your system alive when the market throws curveballs that no one saw coming. But for us at Minotaur Trading Systems, here's where it really gets interesting. We actually work directly with Giovanni Santastasi, the PhD physicist who discovered the power law theory that drives Bitcoin's behavior. Giovanni didn't just develop the theory, he ran our algorithmic trading system himself. And when he combined his scientific thesis with our approach to automation, algorithmic trading, and risk, he saw firsthand just how powerful this framework is in real markets. And this is where the power law comes in for us. The system is designed with an understanding of where Bitcoin sits relative to its long-term power law, not as a crystal ball and not as a line in the sand, but as context. That context guides how your capital behaves. When price is stretched above the power law, the system is going to dial back that risk. When price is compressed, it's going to allow for more defensive and patient deployment. The power law doesn't inform our system of where the price is going. It tells the system how much risk the portfolio is going to be able to handle, and that's the core objective of risk engineering. The system must be able to be wrong without being wiped out. Early entries don't need to be perfect, they just need to be survivable. And when risk is engineered correctly, being wrong doesn't force you into action. It doesn't trigger panic. It simply triggers the next pre-designed response. And that's what lets a system operate calmly through volatility. Not because the market is predictable, but because the behavior of your capital already is. Step 4, you need to automate execution end to end. So once your strategy is defined and risk is engineered at the portfolio level, automation stops being a concept and it becomes a machine. At this point, there's nothing left to decide in real time. Entries, automated. Defensive scaling, automated. Exits, automated. And when a trade completes, the system resets itself and waits for the next valid opportunity, all on its own. No alerts asking for your blessing, no notifications begging for you to intervene, no just checking in because price is moving fast. Partial automation doesn't free you, it helps you psychologically chain to the screen. And as long as you're attached to execution, human interference always finds a way back. So a true self-running system only works when execution is fully removed from your daily attention, 100% fully automated. The system doesn't need reassurance, it doesn't need supervision, and it doesn't benefit from being watched. At this stage, your role, it changes completely. You're not training anymore. You're monitoring system health, not price. That means focus on execution quality, ensuring risk exposure is behaving as designed, and checking that the system is running within its predefined parameters, not reacting to every candle or short-term blip. Just imagine waking up every day and not actually worrying about what the price is doing. Price has simply become background noise. Structure becomes the signal. And this is where you finally get your time back, finally get your life back. Not because you've stepped stepped away, but because the system was built to operate without constant input from the very, very start. And once this execution is fully automated, you're then ready for the final step. And that's designing your system to run not just unattended, but sustainably and for the long haul. And that brings us to step number 5, design for longevity, not activity. A system that truly runs itself isn't built to keep you busy, it's actually built to last. Most trading systems, they're just obsessed with activity, more trades, more signals, more engagement. It creates the illusion of control, but barely delivers real results. A self-running system flips that on its head. It aims for fewer, high-quality trades, not because opportunities are rare, but because capital efficiency matters far more than constant participation. The system doesn't need to be active all the time to be effective. It only acts when the conditions truly justify it. And that also means that the system can't depend on perfect market conditions. If your strategy only works when volatility is friendly, trends are clean, and momentum lines up just right, it's not robust, it's fragile. Real markets, they don't cooperate, they stall, reverse, and they throw curveballs when you least expect it. A system built for longevity, it expects that, and it's designed to survive, not just to shine in ideal scenarios. There's no need for endless tweaks or constant optimization. Frequent adjustments usually signal that the system was never stable in the first place. A robust system doesn't need ongoing intervention to survive changing conditions. It's simply built to tolerate uncertainty from day one. And that tolerance comes from having clear expectations about drawdowns, about recovery. You see, drawdowns aren't a failure, they're part of the system's natural cycle. When they happen, the system doesn't panic, it doesn't chase, it doesn't abandon its structure. It follows the exact behavior it was designed to under stress. And this is the final mindset shift. Your system isn't trying to win every week. It's not trying to impress short-term bursts. It's built to still be standing, quietly compounding years from now. Most traders, they never make that shift, and they optimize for excitement, for validation, for short-term wins. A self-running system is built for something much quieter. It's built for consistency, durability, and survival across time. And paradoxically, that's where real long-term results come from. But here's the truth. Building a system like this isn't about downloading a bot or copying a template. It's about engineering the entire framework, strategy, risk, automation, execution, so it can run without you constantly looking over its shoulder. So if you want help setting this up properly, not just a bot, but the full system around it, we do this with clients globally. My team operates across Australia, the UK, the US, and the rest of the world, and we help traders and investors engineer automated systems that are built for real capital, real volatility, and real-time horizon. If you want to explore whether this approach makes sense for you, look into the description and click on one of the links. You'll be able to book a call below, and we'll walk you through your goals, capital structure, and whether a self-running system is actually the right fit for you. There's no pressure, there's no hype, just a clear conversation about if and when we can help you. So go ahead and click on those links so you can learn more about what we do.